Let's say 3, 4 years ago when the pandemic hit, right after the kind of shockwave went away, real estate just started booming, right? People were putting offers in to buy a house, 100,000 over asking price because the demand was there, interest rates were low. Well, at that time, the mentality was, and the mindset overall throughout the country was, we can build wealth, we're making money, we're doing really well. Well, now look at the volatility in the market and the uncertainty. We have everyone's stressed about elections and who's going to take what. What's that outcome going to be? And now the mindset shifted a lot to wealth preservation. I want to try to keep the wealth that I've created. So a private lending mechanism or a security instrument like a first trust deed mortgage, in my opinion, is the most secure real estate investment you can get into. And on the private side, typically you have lower leverage loans. So an example, you have $1 million value on a house. As a private lender, you're only going to go 75, 80% of value as is, or you're going to increase do a value add in finance, but you're going to hold back the construction dollars until that rehab is continuing to move along and therefore increasing the value of the property. So then you're going to be at 65, 70% of the future value. Ultimately, what that means is that, there's no time in history, even during the Great Depression in certain areas, especially high growth, high demand, mass population movement, where the depreciation of those real estate assets dropped so more than 20, 25%. It did over time, but it didn't happen overnight. So a lender can kind of hedge against the risk based on doing lower leverage loans. So in my opinion, right now, to give you an idea, my largest family office, most of my larger check writers are all in that security instrument fund, a first trust deed mortgage, hard money loans. Trust deed investors, people who have IRAs, they love to roll over their IRA, do a self-directed IRA into a trust deed investment. They make the interest clip on it, they get taxed on it, or that interest goes back into their IRA and they just accumulate more and then continue to lend out. That is becoming really the movement. Now, I know this is kind of loaded, and forgive me for being a little long-winded.
No,
but
it's good stuff.
I think we all remember the smaller banks, like the community banks, had runs on banks. I think we all know that back in GFC days, we had 14,000 banks. After 2008, we dropped to like 4,500 banks, right? And it's going to continue to drop. How many people, I think, would raise their hand in this case when things were starting to shut down, like SVB and Signature Bank and all that? What was happening is people were pulling their money out of small community banks and going to the Wells Fargos and Chases and the large institutions. Well, that was a calculated move. But as those smaller banks don't have money on deposit, they don't have the ability to lend. So certain banks are more comfortable in their own community to lend where a big institution may not be. So for example, I'm in a secondary market right here, Lake Havasu, Arizona, 2 hours from Vegas, 2 hours from everywhere in Southern Cali, 4 hours in some cases, and then 3 hours from Phoenix. So it's a small community, and the Census Bureau isn't up to date on data. So to try to get a big loan or a private money loan out in this area is going to be more popular than it is to get an institutional bank. Even a bank right here around the corner, a little small community bank, closed their doors. So I think the wave of the future is private lending, especially with investors right now that understand this is election year. Elon Musk can throw out a tweet and crash the stock market. A lot of people are going into cash positions, pulling their money out of stock and going into a security instrument. And then to sum up, because the largest wealth generation right now, or the biggest generation that has the most wealth, is the baby boomers. Baby boomers are seeing what's going on with crypto and FTX. They're scared with crypto. They're going, hey, you know what? I don't know that. It's too volatile. I'm stressed out trying to trade myself. How about I just go into something that I know, real estate? I built all my wealth in real estate for the most part. I built half my wealth in real estate. I'll just keep playing into something that makes sense. Hedge against inflation has always been real estate, what have you. And so you're seeing a lot more movement from investors, people who are looking to retire and move money into, again, a first trust deed security instrument, hard money lending, working with guys and myself, like you and myself, to put that money to work and have the licenses and boots on the ground to oversee that project as well. So to sum up, we are going to disrupt the banking system by controlling the wealth and therefore putting it out and being a lot closer to those assets than like 2008, where you just had thousands of loans on your balance sheet and there was nobody internally to be able to watch over that. A smaller firm like you and I can watch over every asset that's in our portfolio because we don't have thousands of loans. We only have a couple hundred loans. So we can watch over those assets and be a lot closer to it.